I had an interesting conversation this week with Jerry. And Jerry had a coaching session. We talked about a couple of his positions. And it was an interesting discussion that we got into. We started talking about credit spreads and what we look for. And as you guys know, usually the past few years when the market has been strong, I've been very fond in putting together a uh, better approach, a positive and thought out step-by-step approach for trading bull put credit spreads, management techniques, and more. But it starts with step one. What do we look for? What did we find that gave us the best potential return over time, comparing different stock criteria, different option criteria, looking 1 week out, looking 2 weeks out, opening on a Friday for just a 1 week out trade, or opening on a Monday for a 1 week out trade, going 2 weeks out, going 3 weeks out, and so forth. And my preferred criteria is shown right here in the weekly bull put default screen, looking for positions that are 14 days out in time, 2 weeks out. And typically what I'll do is I'll look to open these on Monday. I know that sounds strange after we just said, but what I found with this series, and it worked better to find the positions Monday because too much flux can happen over the weekend. This isn't the same as having a long-term covered call we just discussed for Salvatore and continue selling the call against it week by week. You don't want to see a fluctuation where the stock drops over the weekend and the market opens down on Monday. For a bull put, that's a little bit more dangerous. I'd rather wait for the market to do what it wants to do in those first couple hours in the volatile Monday morning trading, and then enter these trades Monday for the 2 Fridays next, technically 11 days out afterwards. But the discussion I had with Jerry was taking a position, let's say, on PDD. And what I'm going to do back here, I'm going to go back in time a month or so, or maybe 2 to 3 weeks. We're going to go 2 to 3 weeks back in time and look at the back test. But we're looking for positions, maybe 2-point spreads, 2.5 or 5-point spreads. Upstart's a good one here. Receiving a net credit for about a 15% return, looking to hold it for the full 11 days and letting it expire worthless unless we have to manage it to maximize the premium. In this case, I want to get close to that 15% target as much as possible, 12 to 15% target for the 2 week out trade as much as possible. And Jerry brought to me an idea of another options educator who teaches a method of doing bull put credit spreads going 40 to 45 days out in time, potentially, maybe a little bit more, maybe a little bit less, 30 to 45 days out in time, making sure not so much paying attention to the probability, which I'm doing here. We're looking for probabilities of greater than 85%, return greater than 9%, but really we're focused on this wheelhouse here of above, 13 to 17% on the top 4 or 5 trades. But in any case, we're looking for an 85% probability. We're seeing an average about a 15% return, but what does that give us? Well, in this one here, my net credit is 65 cents on a 5-point spread. So I can still lose 435, roughly about 6 to 1 risk reward ratio. I'm risking 435 to make 65 cents. And yeah, so we're looking again at about a 7 to 1 risk reward ratio, roughly. My apologies, 7 to 1 risk reward ratio. But we have a high probability. The other approach, and I'm not saying this is a bad approach, but as the conversation went on, this is kind of interesting to me. The other approach was maybe going 35, 40 days out in time. Let's go to October 29th. And what they would look to do, let's keep a 5-point spread, but they're looking to take in at least 30% of the premium on the 5-point spread. So we're talking about a minimum net credit of $1.50. Now, again, my position, we're deep out of the money. With the stock at 303, we're looking at the 260 put to sell and the 255 to buy. High probability. What I want to look for here is where's my $1.25 premium? It looks to be right there, 260 to, that's not, I want a $1.50 premium. That's not it at midpoint. 15 to 30, that's probably it. 270 to 265. Not too much different. Am I close to what I want here? Is that close to the $1.50? $1.80, great. But let's do a $1.50. So we'll do 15 and 13.50. Okay, now This looks like a 40, 43, 44% return on the position. Probability is only around 70%. You might think that sounds good, but in the testing I did, I found that when you looked at the same stock criteria consistently over 3-4 year period, if you went into the 70 to 75% probability range, it had a success rate of only about 72%. You needed it to be 77 to profit long term. When you went 75 to 80, you got closer to that 77% win rate, but the losses were taking out the gains. 80 to 85 was better, but having the 85% probability or higher, even though I'm only taking in a 15% potential profit in this case, you have an 87, 88% success rate, and it outperforms over time. Even though this looks like a 42%, 43% return, it has to be managed more often, and you're not taking the wins as often as you need to be successful with that ratio. So I mentioned that. He says, well, he doesn't do that. What he does is he looks to close the position when he's made 20% of the expected profit or so, which might happen in 10 to 12 days. So 30, what is 20, 25% of $1.50? We're talking 30 cents, 35 cents, or 40 cents, looking to close in a 10-day period. If the stock does what he wants, taking 20 to 25% of the maximum profit off the table, which means roughly what? Well, on that risk of 350, they make 30, 35 cents. They make a 10% return in 10 to 12 days. Or just take an 11-day out trade and have a 14 or 15% profit. It's the same approach in a sense. It's the same general approach to the position, and that educator is increasing his win performance by closing early and taking 25% off the table. Or we could just keep it simple, of course, and just do the 10, 12, 11-day out trade starting on Monday for the next following Friday and get 13, 14, or 15% over a 2-week period without having the extra management. What is the big advantage of selling that 35, 40-day out position with the lower probability, maybe only 70, 72%? Well, it's the credit, isn't it? You're taking in $1.50, but again, the game plan is to close it in 10, 12 days when you've made 20 to 25% of your profit, or 30 cents, 35, or 40 cents that we're seeing we're getting right here with the standard position and standard approach as well. Multiple ways to skin a cat. It's definitely not a bad position. It's definitely not a bad idea, especially if it's working. This works as well, and we've been showing that and been proving that this approach works well with the right probabilities, but requires less management. I'm more likely to let 87, 88% of these expire worthless with no management going forward and only have to manage the 12 or 15 others. But I thought it was an interesting concept in the sense that the game plan was to do almost the exact same thing you could do with just opening up positions that's 10, 12 days out.